In today's video, we're going to take an in-depth look at financial statements, in particular income statements. Now, income statements, sometimes called profit and loss statements, sometimes called statement of comprehensive income, is one of the two statements that private limited and public limited companies have to publish each year, the other, of course, being the balance sheet. In order for you to become familiar with some of the key calculations and key terms we're going to be looking at in today's video, I've put a familiarisation question on the screen. It's at points like this that you might wish to pause the video in order for you to interact and engage with the activity to better understand income statements. In fact, in each subsequent time when I think it will be a good time to pause, I'll put an asterisk in the top left corner so you can know when to pause the video. So if you've had an opportunity to calculate some of these responses, let's have a look at the answers. So the question was to calculate the following for company ABC. This is a made-up company. They currently sell 1,000 units of £45 each. So that makes the sales revenue 1,000 times 45, 45,000. The cost of goods sold was 20,000, which means that the gross profit would be 25,000. Other expenses being 15,000 leaves us with an operating profit of 10,000. Now, what would be the operating profit if price was increased to 48, but all of the other figures stayed the same? Well, essentially that would mean that the sales revenue would be increased by £3 for every unit that is sold. In this case, assuming that they still sell 1,000 units, the sales revenue would increase by 3,000, meaning the operating profit would also increase by 3,000. Now we come on to the challenge activity, which asks you to analyse the effect that increasing the price would have on gross profit. Now, it may be that gross profit would increase. If you increase the price and there's no subsequent effect on the level of demand, then each unit you sell would increase the sales revenue and therefore gross profit would increase. However, there is a concept within business called price elasticity of demand, which means that if you increase price for some products, demand will fall by a greater extent. And therefore, with some products, if you increase the price by a small margin, demand would fall drastically, thereby decreasing the gross profit. So the definition of income statement, statement of comprehensive income, profit and loss statement. Here it is on the screen. You may wish to pause it if you feel the need to take it down. It is a financial document that shows a business's sales revenue, so that's the money coming in, and their costs or expenses, this is the money going out, to show whether the business has made a profit, hopefully, or a loss, sometimes, over a period of time. The period of time usually being a year. Now, some key terms you'll find in a statement of comprehensive income are on the screen. You may wish to have a go at filling in some of these key terms yourself. In fact, you may already know the formulas. Now might be a good time to pause the video if you want to have a go at that. So you've had a go at filling in some of these key terms and formulas. Let's have a look if you got them correct. First one, sales revenue equals quantity sold times the selling price. Essentially, all the money you've got coming in to your business through selling products. Now, the cost of raw materials, otherwise known as cost of sales, this is the amount it has actually costed you to buy in potentially the raw materials from a supplier or buy in ready-made products from a wholesaler. Of course, before you add on value in order to sell them. Gross profit, the formula for that is sales revenue minus cost of sales. And then expenses, these are other costs associated with trading within the business, not associated with the cost of actually producing the product itself or the raw material cost. This is other things that a business will have to spend money on in order to be successful. Staff salaries being one of them. Advertising being another, insurance being a third. These are things, costs that businesses have to spend money on, but they're not directly associated with the cost of making the sale. Operating profit is simply gross profit minus expenses. And then we come on to the bottom part of the statement of comprehensive income. Now, thus far, all of these 5 entries are associated with everyday trading activities. So they're the main core business. At the bottom, however, interest, whether it be earned from a savings account or paid out on borrowing, will also affect the profit that is made per year. So interest paid on debt or received on positive balances, potentially in current accounts or savings accounts, is also added to the operating profit. Exceptional item sales. Now these are one-off items of income, potentially from selling an asset. The key point being one-off items. You cannot repeat each year these exceptional items. A good example would be potentially selling an unused building or vehicle. Once it's gone, it's gone. You cannot use it again, the only exception being sale and leaseback. Now the final profit for the year, otherwise known as net profit, takes into account all of the previous items. So it's the operating profit plus or minus the interest, whether you've earned it or had to spend out on it, plus any exceptional item sales you might have made. So on your screen, you'll see a basic income statement. However, 4 boxes are missing: the total cost of goods sold, the gross profit, the operating profit, and the interest for the year. If you wish to have a go at these calculations yourself, now would be a good time to pause the video. So let's have a look at some answers. We started off with sales revenue, that's the income into our business, of £100,000. And then we've got cost of goods sold. We opened with stock or inventory levels of £10,000. Then we purchased throughout the year £49,000 worth of stock. We closed with inventory, otherwise known as stock, of £14,000. So it looks as though, even though we spent £49,000 purchasing stock within that year, we actually didn't use it all because we closed with inventory higher than what we opened with. So how do we calculate the cost of goods sold, or cost of sales as it's sometimes known, for the year? We take the opening inventory, we add the purchases figure, and then we take away the closing inventories figure. That would be 10,000 plus 49,000 minus 14,000, which gives us a figure for cost of goods sold of £45,000. Our gross profit would of course be sales revenue minus cost of goods sold, 55,000. And then to work out operating profit, we take away the other operating expenses. So 55 minus 32,000 would give us £23,000. Now this bottom bit you might have found a bit tricky, but operating profit of £23,000 but net profit of £24,000, taking into account the one-off exceptional item sale of £3,000, means that our interest had to be negative £2,000. Whenever you see something in brackets within business and finance, it means it's negative or minus figure. So therefore, the interest was a negative. We got charged that, potentially on borrowing, which leaves us for net profit of £24,000 for the year. Now, the challenge question was to consider 3 ways of improving the net profit of an organisation. If you'd like to have a go at that, then now would be a good time to pause the video. So, how do we improve the net profit of an organisation? There are a number of different ways. One way is to increase the price of your product. Obviously, we talked about the impact of price elasticity demand earlier, but the benefit of increasing the price would simply mean that it may increase the amount of sales revenue being generated. All other figures remaining the same means that your net profit would increase. The drawback, however, as we said, customers may be put off by the price increase and not buy the item as a result. We could also buy cheaper raw materials, which would mean, in benefit, that it would decrease the cost of goods sold, increasing gross profit, and all things staying the same would also increase net profit. However, the drawback, if you buy cheaper raw materials, may mean getting raw materials that are less quality, therefore potentially putting customers off buying your product. Now, a third method of improving profit, net profit in particular, would be to decrease the amount spent on advertising and potentially other expenses as well. But when we're looking at advertising, a benefit would reduce the expenses figure, potentially increasing operating profit. However, when you spend less on advertising, less advertising may potentially mean that customers are unaware of the product, which of course may lead to a reduction in sales in the first place. Those are 3 main ones, but you might also have put a couple of other ones. The first one being seeking a lender that charges less interest. If you are highly geared or you have a lot of borrowing in your business, then seeking a lender that charges less interest may be a good way of bringing down your costs and therefore increasing your net profit. Another way of increasing your net profit would be selling an exceptional item. Of course, selling an exceptional item is a big decision to make because in most cases you will not still be able to use the item after you've sold it. However, it will lead to a large one-off increase in cash income to the business and therefore will, some say, artificially inflate your net profit for that year. Now, there are other things that may appear in more complex statement of comprehensive incomes, and we're going to look at those now. The first thing that might be appearing is discounts allowed to customers. Now, occasionally, if you offer a customer a discount of a certain amount, it's not costing you anything in monetary terms. However, it is costing you in theory because you're not getting the full sales revenue that you would have got if you hadn't offered the discount. So therefore, discount allowed to customers is actually classed as an expense in statement of comprehensive incomes and something that we have to include in our statements. Another thing that is included in these statements is depreciation in the value of assets. Once again, it's not physically costing us money like other expenses, for example, staff wages. However, depreciation nonetheless is reducing the value of our business. Depreciation, therefore, is when things lose value over time. Things that may lose value are vehicles with use and mileage. Other things that may lose value is potentially stock. So, depreciation and discounts allowed appear in the comprehensive income statement as expenses, not as cost of goods sold, they appear as expenses. So, a few tasks if you want to engage and interact with this part of the video are in the blue box. Now would be a good time to pause. So let's go through some answers. The first one, you buy a car for 12,000 and it loses value over time. If the car depreciated in value by 25% per year, how much would it be worth after 1 year? Now, after 1 year, as we take away 25% of 12,000, the car would be worth 9,000. So in that year, the depreciation value that we put in the expenses category of the statement of comprehensive income would be 3,000. That's how much is depreciated by. Essentially, that's how much value the business has lost. After 2 years, given the compound nature of depreciation, we take 25% from 9,000, which would be 2,250. Therefore, the car would be worth 6,750 after 2 years, but the depreciation we would put in our statement of comprehensive income for that second year would be 2,250. The second question was list 2 other items that depreciate in value. So other things that lose value over time. We've talked about vans, vehicles, cars. Any sort of motoring vehicle is likely to lose its value over time as it's used and as a mileage accrues on it, and of course as new models come out which are potentially more fuel efficient, for example, there's less desirability for those older models. Other things which might depreciate in value, things like patents for outdated technology, the value of those would depreciate over time. Other things, machinery which is used and therefore second hand, so to speak, would also lose value. Now let's come on to question 3. These are appreciating items, those sorts of things that go up in value over time. We might here be talking about property, land, buildings. We might also be talking about intangible assets such as goodwill, which might increase in value over time, or a brand which becomes more popular. These are all things that may appreciate or go up in value over time. When we're talking about goodwill and brands, we're talking about intangible assets, whereas property and buildings, these are known as tangible assets. I go through the difference in a separate video and I'll put the link in the description. Now, let's put all we've learned into practice. On the screen is an exam question. The question relates to Bella's beanbags, and the exam question asks you to complete a statement of comprehensive income. It will be tricky, but approach it in a logical fashion and you should be absolutely fine. On the left-hand side, you've got a number of different entries of different costs, expenses, and of course sales revenues. And you've got some additional information upon the right hand side which you'll need to take into account when completing your statement. So let's have a look at some answers. You started off presumably with a table that looked like this. Sales revenue at the top, cost of sales, gross profit, expenses, and net profit at the bottom. Now, the first thing you did was take into account the two types of sales revenue that Bella's Beanbags took in during this financial year. She made sales revenue from cash sales and through credit sales. So once you added the two together, you got a figure of £39,096. Then the cost of sales was given for you, £13,575. Take one away from the other, and of course you're left with a gross profit of £25,521. The expenses part is where it gets a bit tricky. Wages remain at £18,900 and utilities are at £381. The first one that I want to have a look at is depreciation. Now, depreciation is calculated as follows. The fixed assets that she owned and she bought were costing her £2,835 in the first instance. However, she chose to depreciate them at 20% per year. So we have to work out 20% of 2,835. And we came up with a figure of £567. I'll do a separate video about the straight line depreciation versus the reducing balance method of calculation. The second thing we had to include within her expenses was the discount allowed. Now, this was fairly straightforward, it was given to you, but nonetheless we had to include it in the expenses figure. Rent was a third thing, and this was a bit more tricky. Now, the rent for the year was £2,360, but she paid 280 of it in advance, which means that the actual figure for rent in that financial year was 2,080, of course being an expense. So to work out the total expenses, we simply add up those five figures and we come up with a figure of £22,048. Now, our final box is net profit. We've got our sales revenue, we've got our gross profit. So we take expenses away from gross profit and we're left with net profit, in this case of £3,473. Oh dear, would you believe it? Bella's made a few mistakes. Ooh. So, in order to go even further with your calculations, I've put a second exam question on the screen, which helps to extend your learning in this area. So, she's made a few mistakes in her calculation and has once again asked for your help to create her statement of comprehensive income. There's a few changes to the figures, however, so take what you had before and utilize these changes in your answer. Let's have a look at it in just a second. You may wish to pause the video at this point. Okay then, let's see what you came up with. For the second question, here is the solution. Her sales revenue, of course, went up to 40,000, as it said in the extra information. Her cost of sales went up also to £14,000, meaning that her gross profit, her sales revenue minus her cost of sales, ended up as £26,000. Her wages went to 11,340. Her utility bills remain the same, but her depreciation, of course, she chose to depreciate by 40% rather than just the 20%, so that means her depreciation was actually £1,134. The discount allowed remained at £120, and her rent remained at £2,080. Once again, in order to calculate the total expenses, we calculate all five of them by adding them together, and then we get total expenses of £15,055. Once again, to calculate net profit, we've got our gross profit minus our expenses, which gives us an answer of £10,945. Well done if you got that second question correct. So you might be thinking at this stage, how on earth do I remember the order of the statement of comprehensive income? Well, I've got a rather silly way that I use, which I'll share with you now. So as we know, sales revenue minus cost of sales equals gross profit minus expenses equals net profit. It would be helpful, wouldn't it, to have a little acronym to remember it by? Well, this is the one I use. Sales revenue, same first letter of schools. Cost of sales, the same first letter of cool. Gross profit, the same first letter is go. Expenses, even. And net profit, November. Once you read out those 5 words, school's cool, go even in November. I know it's a silly way of remembering it, but schools, so sales revenue, cool, cost of sales, go, gross profit, even, expenses, November, net profit. That's the way I remember it. Hopefully that's useful to you too. So now that we know what a statement of comprehensive income is, we know how to complete and amend them, we even know how to remember the order of them, then we need to know how to analyse them. And the first method of doing this is through the use of a ratio, is gross profit margin. And the calculation for gross profit margin is as follows. Gross profit margin is gross profit divided by sales revenue times by 100. So taking the figures we've just worked with in the second exam question, we do the gross profit of 26,000 divided by the sales revenue of 40,000 times by 100, which of course be 65%. Now on its own, is that good? Is that bad? We don't know. We need some basis for comparison. So we might even consider comparing it to previous years. We might consider comparing it to other organisations. And that will give us an indication of whether our gross profit margin is good or not. The second method of analysis you may wish to use is by calculating the net profit margin. Similar to gross profit margin, but rather than the gross profit figure, we use the net profit figure. So the formula as follows. Net profit margin equals net profit divided by sales revenue times by 100. So in this case, it would be 10,945 divided by 40,000 times by 100, giving us a net profit margin of 27.36%. Once again, similar to gross profit margin, it simply shows the amount of sales revenue which has ended up in the end as net profit. We can compare it to previous years. Alternatively, we can compare it to other organisations to see if it's good or not. This is one of several ratios that are useful when we analyse financial statements, and I've got another video on ratio analysis which you may wish to watch. I'll leave the link in the description. There are a number of other things that you'll need to be aware of when it comes to statement of comprehensive income statements. They are as follows. How cost of sales and cost of goods sold is calculated. We've covered it briefly in this video already. Number 2, the types of assets that may appreciate or depreciate. I alluded to it earlier, tangible and intangible assets. Also, types of assets that may appreciate, depreciate, the difference between fixed assets and current assets. Number 4, what businesses actually do with the profit once they've made it. A key topic to look at is profit utilisation. Number 5 is how to compare companies' income statements, the topic of ratio analysis. And the last one that you will need to be aware of when you come across financial statements is actually the other financial statements that private limited and public limited companies need to publish. That is the balance sheet.